All right, welcome. Thank you guys for joining us. It's 4 p.m. on the East Coast, and we are going to get started right now with our webinar with Global Wired Advisors. Again, we're glad you guys are here, and we hope you brought lots of questions, because that's what we're going to be focusing on in this webinar, is answering and getting to any questions you might have about selling your business. I want to give the first couple minutes to the guys at Global Wired Advisors. You're going to meet Joe, Chris, Jason, and Chris, and they're going to quickly introduce themselves and then kind of talk about their process to selling a business, and then we'll get to questions. So start posting your questions. We'll get to them in just a couple of minutes. This gives time for more people to join us and for you guys to also formulate your questions too. All right, I'll let you guys take it. Thank you guys for joining us.
Great. Hey, Kate, it's great to be back on. I think it would be useful to go through our background and you give people a sense of where we're coming from, what we've built, and what we're aiming to do. So really, it starts with a firm called Providium Group. And Providium Group is a middle market investment bank in Charlotte, North Carolina. And it's designed really to take core investment banking expertise down to the lower middle market space. And we found in doing that we were just encountering a number of people that had digitally native businesses, specifically Amazon-based businesses. So with that influx of interest, we quickly worked to build a subsidiary of Providium Group called Global Wired Advisors. And Global Wired Advisors takes core investment banking expertise that we apply at the Providium Group level into the digital domain. That is the whole goal of basically the Providium Group Global Wired Advisors connection. Our mission is to elevate the M&A process in the space. With respect to our backgrounds are pretty much traditional investment banking backgrounds. You can see our bios up now. For myself, I spent a lot of time at Wells Fargo with the investment banking team there. Prior to that, Deutsche Bank, number of years with Citibank, started my career on the floor of the Chicago Mercantile Exchange. Jason ran capital markets at Bayview. He was at Bank of America for a while, and he has started and exited a number of different small businesses, some digital. Our other partner is Chris Bodnar. He has spent a number of years in the venture capital space, worked on a number of different deals, worked for a number of different hedge funds, and Chris is our digital expert. He is really one of the key driving forces with respect to our effort in the digital domain with respect to Global Wired Advisors. So, the whole package of Providium Group and Global Wired Advisors, again, is designed to bring really core investment banking expertise into the digital domain. So, with that introduction, I think we can probably go into the process that we follow, what we do with each individual engagement. Jason, if you want to.
Sure. Thank you. Thanks, Kate, again for having us today, and thank you everyone out there for tuning in. I'm going to go through a very brief version of the process. It's actually a rather lengthy and detailed process, but I want to kind of give you an overview, and then during the Q&A session, that'll allow for any kind of digging deeper into more detail that anyone in the audience would like to do. I think sort of building on what Joe said, our process in a lot of ways is a function of our experience and our careers up until this point. And with all of us, coming from really institutional bulge bracket investment banking backgrounds, there's really a way that larger, more complex transactions are effectively run and managed. And one of the reasons for us starting both Providium and Global Wired was we felt like that smaller business owners, including Amazon-based business owners, quite frankly, deserved a much better process, deserved the same level of service and expertise that larger companies benefit from. And so our process really is a function of that goal, that desire, and our backgrounds to be able to bring it ultimately to fruition and bring it to bear with our clients. So our process is a little different. than kind of others that may have been seen in this marketplace until we came along, and we can certainly contrast and compare during the Q&A. But in order to sort of give you a high-level overview, really the beginning of the process would be kind of us consulting with a potential client around their goals. One thing that drives everything we do is, are the goals of our client. We're not trying to fit anything into a particular box. We're trying to work our process around, ultimately what the owners of these businesses would like to accomplish. So if ultimately what what a seller would like to accomplish is to sell the business, then after we consult with a potential client and provide them with our overview of valuation and strategic process around marketing the company, we would enter into kind of the full engagement phase of what we do. So during that full engagement phase, we will really dig deep into the business to understand everything about it, to basically become experts on that business so that we can represent a client in the market without really a lot of assistance from the client. So as we gather and become educated, we build our marketing materials, which are always very lengthy, thorough, and robust. So there's an information gathering portion, a marketing materials building portion, a marketing strategy development portion, all happening up front. And then we would launch into officially marketing a company. Now, there's not really a cookie cutter process. Everything that we do is customized by each business, because depending on the type of business, the type of products that it might sell, the way it's structured, what its ultimate opportunities are, all of that, will lend itself to a fairly unique and individualized type of an approach. So, what we determine in our research phase and our strategy phase will be ultimately executed during the marketing of the company. So we will approach both our network and broader audiences. Our network is 60 to 70,000 counterparties worldwide. We're not going to usually approach all of them because with the strategic marketing plan, we're going to identify a core group of those that are really the best fit, and we're going to approach them with the transaction. The marketing phase will tend to take anywhere from 1 to 3 or 4 months typically. And then once ultimately a counterparty is chosen, then we'll enter a due diligence process. Due diligence, which can get very detailed. I won't dive really deep into that now. That's the chance for the buyer really to verify that the information that's been presented is true, and also populate their files with the appropriate documentation. Legal documentation for the deal gets done during that period as well. And then ultimately the deal will close. So that's a lot, and it's a lot in a short amount of time. And there's a lot of detail there that I sort of glossed over, but we can enter into the Q&A portion of the webinar, and we can dig as deep as the audience would like to.
Yeah, and one of the big questions that I often hear from people is, do you guys have like a minimum value for a business in order to sell it? Like, is there a minimum valuation you need to reach before it can be sold?
Well, what we've seen in the marketplace is businesses sell anywhere from as low as $20,000, $30,000, $40,000. We've seen businesses sell for, all the way up to obviously tens of millions. So from a purely technical perspective, which is further backed up by market data, I think if you have a business that's worth much less than $30,000, $40,000, $50,000, there probably isn't a real big market for it, but it's certainly possible because there are businesses that trade hands even at lower numbers than that.
All right, and I'm just organizing these as they are coming through. We've got a question from Lucas. Does trademark increase the value of a business?
You want to take that one or me?
I can.
Okay.
It can. It can. There are a number of different factors that go into the value of a business, and having a trademark is definitely one of those factors. But I think you have to look at really the whole picture. You have to look at the trajectory of the business. You have to look at margins, supply chain, the whole thing. It's certainly a positive, but I wouldn't isolate it and say that it is specifically a primary driving factor. The whole picture is going to be really the driver of valuation.
Okay, moving along. Our next one comes from Adrian. How is value assigned to a patent when selling a business?
Well, a patent, again, is sort of like a trademark in terms of the value, and not to get kind of overly simplistic, but the value of anything is what someone is willing to pay for it. Ultimately, there is a market for patents kind of on their own. So there is data, comparable data out there that can be used to try and determine value, but really the value of a patent for the most part is what you can do with the patent. So if you can take that patent and then ultimately turn it into revenue and turn that revenue into cash flow, then it will be valued accordingly. So a lot like trademarks, as Joe was saying, patents really enhance value of a company in that it makes it a stronger company if there's IP that is a part of the asset picture for the business. So, but that just sort of gets, we'll call it baked in the cake, and overall value of the company is a function of a lot of different things. But having intellectual property that's part of the asset base is always a good thing and can certainly kind of boost value. But to be able to isolate it a lot like trademarks and say, this is specifically what it's worth, that's a process that is, that answer is really borne out during the marketing process, where the market is ultimately going to tell you what it's worth.
Okay. Next question comes from Ryan. It looks like he's currently listing his Amazon business on BizBuySell. I was wondering if you recommend another site or service to reach potential buyers.
Well, the two main sites for listing a business are going to be BizBuySell and BizQuest. I guess I would be curious to know who he's listing with. That's really going to be a little bit more of a driving factor, insofar as how the process goes. But to answer Ryan's question, the two main sites are going to be BizBuySell and BizQuest.
And I'm going to ask you guys a follow-up question. What's kind of the difference between using a mergers and acquisitions firm versus listing it on a website?
Well, it's night and day. Those are two very different paths. And the thing to remember with respect to using an M&A advisor is that they do it day in and day out. They know the process. They know how to guide you through the process. It's, like using an attorney, or going to see a doctor. You want a professional that can really take your most valuable asset through the sale process to maximize its value in a timely way. So if you're trying to run your business and you're trying to sell it at the same time, and you're going through the sale process and you don't work with a lot of people that go through the sale process every day, odds are good you're not going to have as successful of an outcome as you would as if you engaged an M&A advisor. So the two paths are very different. We strongly encourage people that are contemplating selling their largest asset, probably their business, to use an M&A advisor.
Okay. And Joe, you did an episode with us just a couple of weeks ago where we talked about when you are looking for an M&A advisor, kind of here's what to look for and watch out for, and here's also kind of what makes a good advisor, someone that you would want to work with. So if you guys have really detailed questions about that episode, of course, still ask them here, but that episode can really help kind of answer those questions too. Marilyn, our next question. rule of thumb valuation of an Amazon business?
Well, I'll jump in on that, and then Joe, you can hop in. The rule of thumb valuation is something that is, I would say, a little bit dangerous. Now, the market for Amazon companies and businesses to date has functioned in a bit of a rule of thumb type of way. And our view, and one of the things that we see as a difference, not only with just with us, but in terms of running a process a little more like a larger transaction and more established marketplaces, is kind of the rules of thumb valuation go out the door pretty quickly when the market participants kind of all look around the room and say, yeah, there's a better way here. There's a better way to identify value. There's a better way to extract value. So, what we see a lot in the marketplace are Amazon companies sort of being sold through a relatively quick process that does use more of a rule of thumb type of value. And, that tends to be a range of 2 to 5 times cash flow as a quote unquote rule of thumb. But, I would say that whenever we look at a business and work with a potential client, one of the first things we do is try and get all the information we need to give a much more specific value, even if a rule of thumb type of a value, was something that they started with. So on one hand, again, I hesitate to even say there's really a good rule of thumb value. But, I also acknowledge that so far, the way the marketplace has functioned, there's a lot of that going on. And in terms of what has gone on so far, that's kind of a range of a 2 to 5 times cash flow.
All right, I really like this next question. This is from Lucas. Again, how far ahead of putting my business on the market should I start getting my ducks in a row?
Well, as you need to have as long of a runway as you can, frankly. It's always good to go into the sale process highly prepared. So we recommend anywhere from 6 months to a year. And in that time frame, you're going to be thinking about what potential buyers are going to be interested in seeing. You're also going to be getting together the documentation that a good advisor is going to need to successfully take you through the sale process. Like Jason was mentioning earlier, a good investment banking process is going to be a detailed one. It's going to dive into the specifics in your financials, of course, but also the specifics of your operating model, because ultimately you're going to get the most value in a sale by showing the market an optimized version of your company. Well, the only way that can really be portrayed is if an advisor, a good advisor, has the information that's needed to put that picture together, to build that picture. So the more time, the better, but at a minimum, usually it's 6 months that's required to get things ready for our process to go through a sale. That doesn't mean that we can't accelerate that timeline, but it's just going to require a bit more upfront work to get an optimized value in the sale.
All right, our next question comes from Rod. He writes, for multi-channel sellers, how does that affect valuation? We are strictly resellers that do approximately $500,000 a year. Good for you. In a military niche market, how marketable are we?
Well, there's sort of 2 questions there, Kate. I guess the first one in terms of multi-channel, what we have found to be the case is, more diversification is always better with respect to channel. Now, that the asterisk with that would be as long as it's profitable and as long as it makes sense strategically. Having channels for the sake of having channels doesn't really necessarily help you. But for example, if you're an active seller on the Amazon marketplace and also on Walmart's marketplace, and you're doing significant amount of volume on both, that is, all else being equal, a little better than having all of that volume on just one of those channels. So as kind of a basic general answer, more channels is better, especially because for new potential owners of the company, when you sell, you will have already done the upfront work to be established on another channel or multiple channels. So, it's a little bit easier to grow something that's already established if you don't have to go through the upfront work to set up another channel to sell on. As far as the specific question around how marketable are you, the truth of the matter is we would need a lot more information to give you the answer. And I think that's one thing, that's important about how we approach things is we're not really going to shoot from the hip and give someone a quick answer on something that quite frankly deserves more attention and more detail before a good answer can be given. Purely from the standpoint of, are there enough sales there for someone to be interested? Sure, there are. The fact that it's a reseller of a niche, sounds like military gear, that also, nothing in that information makes me think that it's not marketable. So, that's specifically what I can say with that information at this point. I don't know if you'd add to that. But.
No, that's exactly right. I think that, really our process requires the details, to build that optimized picture of what's been built, and that's where we would determine valuation.
And I want to kind of jump back a little bit to Marilyn's question. You guys have a pretty cool valuation tool. It's actually something I like to play with and try different numbers and see what valuation comes up. I'm posting that right now in the chat, and I'm going to broadcast it too for everybody. So if you want to check out kind of Global Wired, they've built this, like I said, it's a pretty cool valuation tool. You can check that out. So go ahead and look at that. Let me get back. Our next question comes from Gene. What are the most important Amazon seller / vendor central metrics that you or buyers take into consideration?
Well, putting financial metrics aside for a moment, those are always the most important with respect to metrics, just purely revenue and cash flow. But aside from that, I think that trend line is always important, especially as you break down kind of on a product level. What is the trends across the offering? We'll call it the portfolio of products. Are things trending in a positive direction, especially on a year-over-year basis, or are they trending in a negative direction? What we've often seen too is, there's, for a lot of Amazon sellers, there's kind of we call it a creative destructive cycle where there are products that are hitting their peak in their life and starting to roll off and starting to hit a downtrend as new products are rolling on. And so getting a good picture of kind of that mix and where the portfolio kind of is, both from a high level and a detailed perspective, is very important. Ones that will always be important are reviews, obviously, kind of seller ratings, product reviews as well. Seller ratings being more important than product reviews. Number of reviews and quality of reviews are always important on Amazon, for sure. I think that the other one that we see a lot, and it's ironically, it feels a little inversed in terms of whether it's positive or negative on the process, is we go through a fairly robust diagnostic process to understand a client's Amazon activity at a very technical level. And that will include, for example, sizing an opportunity around certain keywords, whereby, hey, if a client's product is likely to be searched for via X sort of keyword and their rankings are lacking, that represents an opportunity for a buyer. And so one thing that we will always kind of preach in terms of one of our mantras is that, for a buyer, it's all about the opportunity. What you've done in the past is very important because it's a track record and it's a stake in the ground. But, really it's all about the go forward. And ironically, we get a lot of clients that, at first will be a little bit, one of the common misconceptions, and I think we even covered this last time in the other webinar, is that I need to have a perfect business in order to be able to sell it. And it really couldn't be further from the truth, because the more that a buyer can look at your business and see ways to improve on the success that you've already had, the more excited they're going to be about that opportunity. So, metrics around, we'll call it ACOS, for example. Is there a lot of opportunity there to improve that? Is there a lot of opportunity to improve where you rank for certain keywords? Is there opportunity to go take product into other Amazon marketplaces? Things like that are pretty important to buyers of these types of businesses.
All right, next question from Michael. Michael owns 2 brands on Amazon. It sounds like they would be interested in selling one brand first. Does that present more difficulties than selling the entire Amazon account?
Not really. It's definitely doable. When you say more difficulties, no, I wouldn't say it's more difficulties. There's, a way to do it. There's a process to go about doing that to effectively transfer over. If both brands are under one Seller Central account, transferring the products of one of the two isn't difficult. And since, a lot of deals get done as asset sales, it's kind of part and parcel with that. I don't know if you'd add to that.
Yeah, no, that's exactly right. What we're finding is that more people are in the exact same situation where, they have different brands and they want to peel one off or peel 2 off. So that's not an issue at all. That's something that can be accomplished just as easily as selling them as a collection.
Let me jump back into some of these questions we got before this. Kind of what are the top 3 to 5 business attributes that contribute most to increasing valuation? I know you guys, obviously, how much you make is important, but what other attributes are out there that are important for your business to sell? Sure.
So going back to a point that Jason made a couple of questions ago, a buyer is going to be interested in the opportunity, the go-forward opportunity of your business. So they're going to be excited about ways to improve your business. So the attributes, the ways that business can be improved, the first obvious one is an increase in top-line sales. Do you have an opportunity to increase market share? Do you have an opportunity to add products that increase your ability to increase top-line revenue? The next would be looking at margin. Are your margins stable or increasing? Are you growing market share, increasing margins, maintaining margins, or are your margins contracting? At the end of the day, it's really cash flow. Cash flow is going to be a huge driver of business valuation, and more importantly, what future cash flow looks like. So if the company is going to market that has the opportunity to increase market share through additional products, maintain margins or increase margins, and thereby increase cash flow, then that's going to be a pretty attractive business. So that model in and of itself has a couple of attributes. Another attribute would be vendor pricing relationships. What does your supply chain look like? Do you have a deep enough moat around the products that you're offering to ward off competitors, to ward off competitive pressures? In the previous webinar that we did, we went through a number of we refer to them as competitive advantage intangibles, which are aside from the financials that are obvious things that people are going to look for, obvious attributes people are going to want to see in a business sale, that would increase the value of your business. Again, one of those things would be your vendor relationships. There are a host of others. So.
Right. Sorry, I'm jumping through questions here and managing all that. And I do appreciate you guys for all joining us. If you have any other questions, send them, those to us right now. What about a legal structure, LLC versus EPIS Corp? I mean, does it matter how your business is structured when it comes to a sell?
Well, it doesn't really. I mean, we can work through any structure. I think most structures that we see are LLCs, and most business sales that we see are asset sales. So they are not stock sales. So what we counsel people to do with respect to putting a company together is to really frankly, talk to your attorney, talk to your tax advisor, look at your unique circumstances, and decide which legal entity is going to be best for you, with the understanding that when the time to sell comes, most transactions are going to be done as asset sales and not stock sales.
Oh, I should have my mic on. We're going back to Lucas. Are buyers usually corporations or other individuals? What kind of buyers are out there? And I know we talked a lot about this, so this is actually a question I really like. But tell us about the buyers that are out there.
Sure. Yeah, we covered this a little bit on our last webinar, and really there's kind of a universe, and they tend to participate in different sectors of the market. So it goes everywhere, kind of on one hand, from individuals. There are a lot of individual buyers out there for Amazon businesses, all the way up to large private equity firms, family offices, as well as large strategic buyers. And I'll cover those a little bit here in more detail. But individual buyers tend to primarily be active in Amazon businesses that are valued under $1 million, especially under $500,000. That's where you see almost exclusively individual buyers. Not all the time, but almost, for businesses that are valued in that kind of range. As you start to go up in value, then the buyer profiles start to change a little bit. And there's not a hard and fast line where one ends and the other begins. There's sort of a gray area where they tend to be mixed as you kind of go into the next sector. So, as you go up in valuation, you start going from more individual buyers to more, we'll call it financial, buyers. You start out with more loosely formulated financial buyers like search funds, smaller family offices. And for those that you don't know, a family office is simply, there's usually a wealthy family who has a lot of capital, and they hire people to just manage their capital for them. And so they're out looking for investment opportunities for that wealthy family, and looking for anything that's interesting. Some of them tend to be business and sector specific, and others are more generalist. But so as you get up to larger transactions, you get into more search funds, which are really just a loose formulation of individual buyers acting as a group. And then you get into smaller family offices. And then you start to get into kind of bigger family offices and private equity firms, as well as larger strategic types of buyers. So for those of you who don't know, a private equity firm, of which there are over 5,000 now in the United States alone, many more worldwide, is really a company that goes out and gets investors, third-party investors, to invest in a fund that goes and purchases equity or 100% interest in private companies. That's where the name private equity comes from, rather than public companies, which would be more public equity funds. And then when I say strategic, what I mean is really a corporation that is already operating in a certain industry sector. Let's take beauty products, for example. that is actively looking for acquisitions in order to grow through acquisition. And that would be more of a strategic type of a buyer. And that's something that, from deal to deal and client to client, that's very specific to that client, because the potential strategic buyers for a business usually, kind of break down industry or product type lines. So a strategic universe for one client, that sells one type of product will be completely different for the next client who sells a completely different, type of product or group of products.
And does it depend on obviously if you're looking to sell, you might be looking to just walk away from the company with a nice big payday. But does it depend too on who's buying your business, whether or not you might stay on as like a board member or acting CEO or in some sort of role still involved with the company? Or is it, in most cases, it's you sell your business, you walk away?
Well, I would say that with kind of, as you get up into larger transactions and you have participants like larger family offices and private equity funds, the deals tend to have more structure to them, number one, and it's more common for those buyers to ask a seller to roll equity, which means, let's say they sell 80% of the company and they retain 20%, and then have a role in the company going forward. So as you get into larger deals, that becomes much more common. With kind of smaller transactions where it's mostly an individual buyer base, that's far less common, because most of those buyers are looking at the business as an owner-operator type of opportunity. So they want to, frankly, buy the company, replace the current owner themselves. They usually will ask the existing owner / seller to provide some transition consulting. And that really varies widely from deal to deal. Is it a month? Is it 2 months? At what point is there additional compensation? Those kinds of things. But it's much, much more common we'll call it in transactions, say under $2 million in particular, under $1 million for sure, that it's mostly a sell and walk away type of a situation.
Okay, thank you. This is from Rod. Is it possible to transfer an existing seller account on Amazon to a buyer, or do they need to create their own account and then transfer inventory?
No, it's possible. There's a process that you go through that's sort of tried and true in terms of transferring the account. So that's exactly what you would do, because you don't want to lose any of the, we'll call it the goodwill that's built up, from a seller perspective. So the entire account transfers, and then the new owner, the new corporate information for the owner is attached to the old account.
All right. Our next question comes from, I clipped away from the chat. This is Michael. He says it's a $64 question. So I'm guessing he's going to Venmo me $64. But what are your guys' fees? Can you kind of give us a sense of what that looks like?
Well, can you shoot first?
Sure. So, our fee structure is really somewhat engagement dependent. We are a bit different than other advisors on the market today. And, we will do, a preliminary consultation to determine what's going to be involved to get you an optimal value in a sale. And once we have a feel for that, we will have some idea as to how much work is going to be required to take you through that process in an optimal way. And that will really dictate what our fee structure is. We follow, like other investment bankers, we're going to follow a modified Lehman scale, where success fees are going to step down, by brackets, depending on valuation. And in some cases, there is going to be an engagement fee, an upfront fee, again, dependent on the amount of work that we believe we need to take a client through to have an optimized outcome in a sale.
Next question is from Rod in reference to cash flow. Does that mean total sales revenue, total profit, or EBIT?
Well, I would say it partially depends on kind of the size of your company and the buyer base. Not that the math changes, but the specific metric that the buyer base is going to pay attention to will be a little bit dependent on the size of the company and the market that we're focused on. So to be very specific, for transactions that are much more likely to be purchased by individual buyers and individual kind of owners, there's a metric called seller's discretionary earnings that is really the cash flow metric that is used. And what that specifically means, kind of as a back of the envelope type of a calculation, just imagine taking net income and adding back all of the specific kind of owner benefits of the business, which would include any salary that the owner is taking out of the business, any health insurance that the owner is receiving from the business, if the owner is receiving, vehicle expenses being covered in the business, so on and so forth. All of those are added back to net income to ultimately get to a seller's discretionary earnings type of a calculation. With larger transactions, kind of what the family office and private equity and strategic buyer world tends to care more about is really EBITDA, which stands for earnings before interest, taxes, depreciation, and amortization. So what we do with those types of deals is we calculate an EBITDA, that we would present to the market during the marketing, and that's what it would really price off of.
And then this next question comes from Rob. He is a LLC manufacturer. Good for you. That's awesome. With trademarked and brand Amazon registered brand. He doesn't allow resellers Amazon, so they own the space. Is it feasible to sell the Amazon business but not the underlying manufacturer business? I just want to say to you, Rob, you are awesome. Good for you. And would provide the buyer with assurances of sole Amazon seller of the brand. So sounds like he wants to keep that locked in. He doesn't want resellers jumping on even if he were to sell.
Yes, he absolutely can. He can sell the Amazon-based portion of his business, and we see that all the time as well, because there are a number of established brick-and-mortar manufacturing-based businesses that over the past couple of years have kicked off Amazon sales efforts and our other online sales efforts, and they've exploded. And a lot of these business owners are looking at that portion of what they have, and they see tremendous value in basically doing a divestiture of that particular portion of the company and then reinvesting proceeds back into the original company to grow it and to do other things. So absolutely, the online portion of a business can most definitely be carved off really as a separate company and it's sold as a separate company. So that's not an issue at all.
Yeah, and I'll just add to that and it sounds like the individual that sent the question kind of already understands what the main focus would be around the ongoing relationship between the manufacturing company and the Amazon business. I think it would really come down to the terms of that relationship, how long he's willing to protect that Amazon, the Amazon seller, and the proof would be in the pudding, frankly, in terms of that, the terms of that deal. But as far as the kind of general ability to do it, there would be no issue as long as that new buyer, the new owner of the Amazon portion, felt like they had real protection on the product. So that would be a very detailed discussion along the way.
Our next question comes from Wally. I live in Australia. Thanks for getting up early with us today, Wally. Appreciate that.
Thanks,
Yeah.
He's in the process of getting an LLC with the idea of selling his Amazon business when he thinks the timing's right. So my question is that, will it be compulsory to have an active U.S. bank account open to do all of this?
Well, you don't necessarily have to be domiciled in the U.S., to sell on Amazon. I think that, really the organizational structure that you put in place, where it's domiciled, how it's banked, is going to depend in large part on how you intend to operate the company. If you're based in Australia, having to set up bank accounts in the U.S. and having to put into place organizational structures here in LLC in the U.S. isn't necessarily hard, but it's an added step that may not be necessary, from the standpoint of selling on Amazon. So, I think that if your goal is to sell on Amazon, then I wouldn't necessarily be inclined to set up an organizational structure that's in the U.S. and go through all of the steps that are required to do that when you can quite easily do it from down under.
Next question is from Al. We invented a totally new product to the world. Congrats, that's awesome.
Yeah.
In the past 6 years, creating 5 stars good feedback rating across multiple channels. How potential is a new product that can be marketed as seen on TV? Does it have more probable sale and annual income to increase 6 or 7 times as much? We also don't advertise much at all.
So if I think I understand the question, it sounds like in terms of taking the product from Amazon to an as seen on TV type of a product, would that ultimately add value? Kate, do you understand it?
That's how I'm understanding it. Al, feel free to clarify if we're wrong, but I'll let you guys answer, and then Al, you can ask any follow-up questions, and we'll get to them too.
Well, I'll toss in first, and Joe can add to this. Again, if you've created a product and it's done well on Amazon, kind of from a general perspective, one of the things we see all the time from smart buyers is if a product has been fairly Amazon-centric, what are the ways that I can capitalize on what's been created off of Amazon? That's a huge topic of conversation with pretty much every transaction that we do. And so, if there's an opportunity off Amazon that is a very profitable one, then that's going to be a big driver. Now, the more work that you've done to prove out a potential opportunity, the better off you'll be, because there will be more meat on the bone, if you will, to kind of holding that up as a real opportunity going forward. So I hope I answered the question there. I don't know if you would add anything to that.
No, I think that's right. I think that, if the goal is to leverage the success that you've had on Amazon, then you're really just looking at other sales channels. And it sounds like, going on television is one of those channels. So really it sounds like you're really trying to estimate what the increase in top line and of course bottom line is going to be from opening up that channel. And, that's going to take, I guess, a little bit of in-depth analysis to really see what an impact on sales that's going to have. But if you're successful on Amazon now and you've established the fact that there's a market for the products that you're selling, then it is probably time to look at other channels to expand market share, for sure. Hopefully we've answered the question.
So we've got a little bit of follow-up from Al. He said for the potential buyer. So it sounds like creating a roadmap for a potential buyer
Gotcha.
Hey,
okay.
You can
Sure.
take this as seen on TV marketing type product, new product, never been invented before. Still amazing. That's awesome.
Yeah, so that goes back to really showing, when you go to sale, to showing an optimized version of the company. And again, buyers are interested in what the company is going to do much more so than what the company has done. So if in the sale process we can flesh out the additional channels, one of those being the TV channel, and based and succinctly put a sales estimate and a bottom line pickup and cash flow estimate associated with that channel, then yes, it is going to increase value in a sale for sure. You have to remember also that buyers are discriminating, and they're going to want to know, if that analysis is solid. If the premise that those sales are based on is just an idea, then it isn't going to have as much weight than if more substance is put around what we think we can truly sell. If there's good hard data supporting kind of the connection between Amazon's success and opening this channel up, for instance, then that's going to go a lot further.
All right, our next question comes from Lucas. Does social media following and an email list size matter when it comes to valuation?
Yes, the short answer is yes. And the direct reasoning behind that, it's not really just purely stats, right? It's about what you can do with that. And those are real assets. Having a large social media presence, having a great email list means opportunity, because you can use those assets and ultimately grow the company. Especially, again, what we see a lot of times, especially from we'll call it more sophisticated buyers, are if you have brands that have grown up on Amazon but have shown to have real brand recognition and have built out a strong social media presence and have an email list that can be used in marketing, that is, those are very good boxes to check in terms of someone being able to say, all right, I can really take this brand and I can do a lot with it. And so it gives you a lot to work with. And so ultimately, if a company has that, has those things as part of their assets, it's looked on very favorably by any potential acquirer, for sure. And we encourage clients all the time that come to us early enough in the process. If we look and they've really gone out and built, a very interesting brand, a very interesting business, but they haven't been very active on social media, or they haven't really gone and tried to build a good email database, it's one of the first things we suggest that they start doing.
It's one of those get your ducks in a row that
Sure.
Lucas was referencing earlier. Next question's from Lois. She did the evaluation form, and for everyone watching, I put the link to the valuation tool kind of towards the top of the chat, so you can easily see it from there. It's saved right there. So she did the form and got an estimate between what her business might be worth. Mm-hmm. She did not include her salary as a monthly expense, and she's wondering if she needs to add that in. She's currently an S Corp, and she takes both a draw and a salary.
No, you would not. When we say add that in, you would not deduct that from the expenses, because that goes back to the seller's discretionary earnings calculation, where it's all going to be added back anyway. So expenses would, in terms of using the valuation tool, you should not include any salary that you're taking in the expenses.
Maybe we need to do this another time, but just do like a walkthrough of your valuation tool sometime,
Yeah, sure.
just so people can see the process you guys follow. I think it's super cool.
Yeah, and one note on that. I mean, the valuation tool is a quick way to drive to, a rough estimate of where a company may trade for. The point that we need to make with respect to that is there are a lot of other factors that go into really building that optimized version of a company that a buyer is going to be interested in. The valuation tool is a fantastic starting point, because without a starting point, you don't really know roughly the value of what you built. However, there's so many other things that need to be layered on to that valuation and taken into consideration, things that could increase value and some things that, may not. So I guess to disclaim the valuation tool somewhat, we just need to keep in mind that there really is no substitute for going through the process, the full diagnostic process that we take people through to prepare them for a sale.
And I am going to right now throw up the contact info. This is actually Chris Schipferling's email address. So he's doing behind the scenes stuff, but he's the one that gets to start with you first. So you guys can reach him at cs@globalwiredadvisors.com. I believe you guys do. What's the consultation that you guys do when people email Chris and want to learn more?
Well, what we typically do, Kate, I'll describe it in short, is we will go through. So the first thing that Chris will do is Chris will just get a general overview from a potential client about their business, kind of what are they doing, what's the 30,000, 20,000, 10,000 foot kind of view, and talk a little bit about the goals that the client has, and really kind of go through a lot of the preliminaries. And usually Chris will offer some fairly quick feedback on that call around, hey, this is from what you're telling me, these are some thoughts about how we might be able to execute on your goal. And then the next step would be to get some preliminary financial information from a client. And then what we're going to do is we would have a follow-up discussion with the client after the financials are received, where we can ask a number of questions, and then come back with a much more specific view on value. So all of that is kind of happening as an upfront process, really before a client would really decide to engage us, because what we've found is in order for someone to really decide how they want to proceed, they need to have enough information and enough feedback and enough color around how we would see the process going, what we think the specific range of value would be, how long it might take to sell the company, all of those things before deciding how they want to move forward. So it's really kind of our upfront, we'll call it consultation process, is it begins with that phone call with Chris. And then if it makes sense to move beyond that, it goes into more specifics around valuation plan.
And once a seller does engage with you guys to sell, and this is from me, and I guess this is also kind of my last call. If anyone else has questions, post them now. You can always email Chris too, and he can answer those questions for you as well. But once you guys engage with a business owner, someone that wants to sell their business, how involved are they in the selling process? How much of their day is going to be taken up by selling their business?
Well, I'll start with that, and Joe, you can jump in. I would say that I'll start by saying our goal is to have our client be involved as little as possible in the process. Up front will be when that'll be the majority of their time investment, will be as we're gathering information from them and putting together our marketing materials and really becoming, as I said at the beginning of the webinar, quasi-experts, if not full experts on the business. After that, our process is structured such that we're really out marketing and talking about the company and working with potential buyers, while our client is doing their job of just simply running the business. And we only involve our clients with a potential buyer once they've gone through a number of steps with us where we feel comfortable that they've done a lot of research, they have done a lot of analysis, they have asked a lot of good questions that we've already answered, and now they're showing a very significant interest in buying the company and have shown an ability to buy the company. And at that point, and that point only, will we get our seller involved with speaking with them at all. So I don't know if you'd add to
Yeah,
that.
no, that's good overview. I think that sellers should be prepared for really an information download to us up front, where we're going to request a lot of information, we're going to organize it, we're going to go through that information with the goal of really understanding your business. Understanding, I like to say, understanding your business the way a CFO or a COO would, a chief financial officer or chief operating officer would, because we need to have that level of understanding to build the appropriate offering material to take your company to market. So there is a fair amount of upfront engagement that is required to really kick that process off. But once we have the information that we need and we've gone through a couple of interviews and we understand the business model, we go to work building offering material. And just as Jason described, we know enough about the company to talk to potential suitors the same way you would, technically, you the buyer would, or you the seller would, sorry. And we're going to shorten, in effect, the time in due diligence that normally is required to get someone up to speed. Because what we see a lot of today, unfortunately, is this preliminary information step is skipped and material is put together without a good, deep understanding of the company. It's put on the market, potential buyers show up, intermediaries don't know enough, about the company really to convey the essentials sometimes. So the seller is often pulled into a lot of different telephone conversations. And then when a potential suitor is found and due diligence is entered, a lot of things are uncovered that should have been uncovered and should have been discovered and basically worked through months earlier, in the process that we do on the upfront. So there is a fair front-loaded time that's required really to go through the process correctly, but it pays dividends in the end. It pays dividends, with respect to shortening due diligence, with respect to us minimizing the amount of time that a seller has to spend on the phone with potential suitors. And ultimately, it's going to lead to a higher valuation of the sale.
I just want to thank you guys so much for spending time just answering questions. That's super helpful, especially in this space. There can be a lot of misconceptions and misunderstandings when it comes to selling your business. So thank you, Joe. Thank you, Jason.
Absolutely.
Chris and Chris for joining us. I know Chris has been behind the scenes helping us run everything here and make sure it all goes smoothly. I have recorded this whole thing, so it's all going to be saved and uploaded to YouTube in the next couple of days, and I'll make sure to email it out to everyone that registered for the webinar. So again, thank you guys. Thank you guys for your time. Thank you guys for your questions. And just, it's been great kind of getting to know the process and getting to know you guys even better. So everyone have a good day.
Yeah, thanks, Kate. We really appreciate it.
Yeah, and Jean, yes, the previous webinar is on YouTube. I'll send it to you. But yeah, if you have any questions, you can email Chris. Go check out the valuation tool and have a great Monday and a great new week. Thanks.
Yes. Thanks, everyone.
Thanks for everyone.
Yeah.
Take care.